I need you to stop what you're doing and pay attention to what I'm about to show you. Because what I discovered last night, after 12 hours of digging through data, cross-referencing COMEX reports, analyzing LBMA filings, and reverse engineering institutional positions, is absolutely catastrophic. Bank of America and Citigroup, two of the largest and most systemically important banks in the United States, are collectively short 4.4 billion ounces of silver. Let me say that again, slower, so you understand the magnitude. 4.4 billion ounces. Now let me tell you what global annual silver mine production is. 800 million ounces per year. Do the math. These two banks have shorted 5.5 years of the entire world's silver production. Not 5.5%, not 5.5 months, 5.5 years. This is not normal. This has never happened before in commodity markets. And what's about to happen will either make you a fortune or destroy your wealth, depending on whether you understand what's coming. Yesterday, silver hit $92 per ounce. Then, in a matter of minutes during overnight trading, it crashed 6% to $86. Then it pumped back to 91. Now it's crashing again. Most people see a normal correction, some volatility, profit taking, standard market behavior. But I've been in these markets for over 20 years. I've called every major top and bottom for the past decade. And when I see this pattern with this data at this moment in history, I don't see a correction. I see a trap. I see banks fighting for their survival. I see the early stages of the biggest short squeeze in commodity history. And in the next 30 minutes, I'm going to show you exactly what's happening, why it's happening, how it ends, and what you need to do right now to position yourself on the right side of this trade. Because when this breaks, and it will break, silver won't stop at $100. It will gap to $150 overnight. And the first major bank to declare force majeure will trigger a systemic crisis that changes everything. Let me show you the smoking gun. This is data from the Commodities Desk, updated January 15th, 2026. These are the estimated institutional silver short positions for Q1 2026. Bank of America, short 1,000 million ounces. That's 1 billion ounces. That represents 125% of annual global mine supply. One bank, 125%. Citigroup, short 3,400 million ounces. That's 3.4 billion ounces. That represents 425% of annual mine supply. One bank, 425%. Total combined, 4,400 million ounces short, 4.4 billion ounces, 550% of annual mine supply. Now, before we go any further, let me explain what short means for anyone who's not familiar with derivatives trading. When you short a commodity, you're making a bet that the price will go down. You borrow the commodity, sell it at today's price, and promise to buy it back later at a lower price to return what you borrowed. If the price goes down, you profit. If the price goes up, you lose. And if the price goes up a lot, your losses are theoretically unlimited. But here's the key difference with these institutional shorts. These aren't small speculative positions. These are massive legacy positions that these banks have been accumulating and rolling over for decades. They've been shorting silver as part of their derivative books, their hedging strategies, their market-making operations. And for years, it worked. Silver was stuck between $15 and $30. The banks made money. The shorts were manageable. Life was good. But now, silver is at $92, and at $92 per ounce, the combined liability of these two banks is approximately $390 billion. Let me put that in perspective. Bank of America's total market capitalization is around $320 billion. Their entire short position in silver, at current prices, exceeds the value of their entire company. Citigroup's market cap is around $120 billion. Their silver short position, at current prices, is worth over $300 billion. That's 2.5 times their entire market cap. This is not a manageable risk position. This is an existential threat. This is survival mode. Now you're probably asking, how did we get here? How did two major banks end up with such insane, suicidal short positions? The answer is a combination of arrogance, market manipulation, regulatory capture, and a fundamental miscalculation about silver's supply and demand dynamics. Let me take you back to understand the history. For decades, silver has been treated as a secondary metal. It's mined primarily as a byproduct of copper, zinc, and lead mining. Only about 30% of silver comes from primary silver mines. The rest is incidental production. This meant that for a long time, silver supply was abundant relative to investment demand. Sure, there was industrial demand, but it wasn't critical. It wasn't life or death for manufacturers. So the banks, particularly JP Morgan, Bank of America, and Citigroup, started accumulating short positions. They would sell silver futures contracts to suppress the price, accumulate physical silver at low prices, and manage the paper market to their advantage. This strategy worked for years. The banks made billions. Silver stayed cheap. Miners struggled. The market was under control. But then something changed. Actually, several things changed simultaneously. First, the green energy transition accelerated. Solar panels require silver. Each panel needs 15 to 20 grams of silver for photovoltaic efficiency. Global solar installations exploded from tens of gigawatts to hundreds of gigawatts per year. Suddenly, industrial demand for silver wasn't just a nice to have, it was mission critical. Second, electric vehicles scaled up. EVs use significantly more silver than traditional cars. Battery management systems, charging infrastructure, autonomous driving sensors all require silver. As the world shifted toward EVs, silver demand surged. Third, 5G infrastructure build-out. Every 5G tower, every advanced electronics device, every AI chip requires silver. The digital transformation of the global economy became a silver consumption machine. Fourth, the money printing era. From 2008 onward, but especially after COVID in 2020, central banks printed trillions. That liquidity eventually found its way into hard assets. Gold went from $1,200 to over $4,600. Silver, which had been suppressed, started catching up. And finally, fifth, China's strategic resource reclassification. On January 1st, 2026, China restricted silver exports, reclassifying it as a strategic resource. Only 44 approved companies can export, and only with government licenses. China controls 60 to 70% of global refined silver supply. They just turned off the tap. All of these factors converged, and the banks, they were caught on the wrong side of the trade with massive short positions accumulated over decades. They thought they could control the market forever. They thought they could keep rolling these positions, managing the price, suppressing rallies. They were wrong. Now let me show you why the math is absolutely terminal for these banks. Why this doesn't end well. Why they're fighting for survival right now. Annual global silver mine production. Approximately 800 million ounces per year. This is roughly stable. It hasn't grown significantly in years. In fact, it's declining slightly as ore grades fall and older mines deplete. Total institutional short positions, 4.4 billion ounces. Simple division, 4.4 billion divided by 800 million equals 5.5. That means even if every single ounce of newly mined silver for the next 5.5 years went exclusively to covering these short positions, and nobody else got any silver for anything, these banks still couldn't fully close their shorts. But wait, it gets worse. Industrial demand for silver is approximately 550 million ounces per year and growing. Solar panels, EVs, electronics, medical devices, military hardware. This demand is inelastic. That means manufacturers will buy silver at any price because they have no substitute. Production stops without it. Investment demand is approximately 200 million ounces per year and surging. As people lose faith in fiat currencies and see gold and silver rising, more money flows into physical precious metals, jewelry, and other demand, about 50 to 100 million ounces per year. Added up, 800 million ounces produced, 700 to 800 million ounces consumed by non-bank entities. That leaves basically zero silver available to cover bank shorts from new production. So where does the silver come from to cover 4.4 billion ounces? It doesn't exist. The only silver available is existing above ground inventory, COMEX registered inventories, LBMA vaults, Shanghai Futures Exchange, private stockpiles. But here's the problem. Those inventories are collapsing. COMEX registered silver is down 70% since 2020. We're talking about maybe 100 to 150 million ounces available for delivery. That covers 3% of the short position. 3%. The math doesn't work. The math can't work. There's not enough physical silver on planet Earth available for purchase to cover these short positions at any reasonable price. And that means one of two things happens. Either the price of silver goes to a level so insanely high that industrial demand gets destroyed and holders are forced to sell their physical silver. We're talking potentially $300, $400, $500 per ounce or higher. Or the banks declare force majeure, cash settle the contracts, and trigger a complete breakdown of trust in commodity derivative markets. Either way, the system breaks. Now let me explain what happened last night. Because this is where it gets really interesting, and this is where you see the bank's desperation in real time. Yesterday, during US trading hours, silver hit $92 per ounce. It was pushing toward $93, $94, with momentum building toward the psychologically critical $100 level. If silver had broken $100 per ounce yesterday, here's what would have happened. First, massive media attention. CNBC, Bloomberg, Wall Street Journal, everyone would be covering silver breaks $100 for first time in history. That brings in retail FOMO. That brings in institutional momentum traders. That accelerates the move. Second, options expiration dynamics. There were massive call option positions at the $95 and $100 strikes. If silver broke 100, those options go in the money. Market makers have to hedge by buying physical or futures, which drives the price higher. It's a gamma squeeze. Third, margin calls on short positions. At $100 per ounce, the bank's short positions would be worth $440 billion. Their clearinghouses would require additional margin. Their risk departments would be in full panic mode. Fourth, potential forced liquidation. If the banks can't post sufficient margin, they'd be forced to cover shorts by buying silver, which drives the price even higher, which triggers more margin calls. It's a death spiral. So what did they do? They waited until US markets closed. They waited until trading volume was thinned. They waited until it was the middle of the night in Asia and early morning in Europe, when liquidity is at its lowest. And then they dumped massive amounts of paper silver contracts onto the market. Within minutes, silver crashed from $92 to $86. A 6% move in minutes on no news, no fundamental change, nothing except massive selling pressure. This was not normal market behavior. This was not retail investors taking profits. This was coordinated, strategic suppression by entities with the firepower to move markets. The fingerprints are all over this. You can see it in the volume spikes. You can see it in the order flow. You can see it in the fact that physical silver premiums increased while the paper price dropped. Think about that. The paper price dropped $6, but the cost to actually acquire physical silver went a P. Dealers' premiums widened. Delivery delays lengthened. Lease rates, the cost to borrow physical silver, spiked. That tells you everything. The paper price went down, but the real price went up. The two markets are detaching. And here's the most important indicator. Silver went into backwardation. That means the spot price is higher than the futures price. Normally, futures trade at a premium to spot because of carrying costs and time value. But in backwardation, it means people don't want to promise to deliver silver in 6 months. They want the metal now. They're willing to pay a premium for immediate delivery versus waiting. Backwardation in a commodity market is a signal of physical shortage. It's a signal that the paper market is losing credibility. It's a signal that the end game is approaching. Now let me walk you through what happens next, because we're approaching what I call the force majeure moment, and you need to understand what that means. Force majeure is a legal clause that allows a party to a contract to not perform their obligations due to extraordinary circumstances beyond their control. Natural disasters, wars, acts of God. In commodity markets, force majeure gets invoked when a seller cannot deliver the physical commodity they promised to deliver. And that's exactly where we're heading with silver. Right now in wholesale markets, dealers are already quoting 6-week delays for large volume silver deliveries. Some are flat out saying not available for orders above certain sizes. The US Mint suspended sales of silver numismatic products on January 13th because they can't price products fast enough. Physical premiums in Asia are at 30 to 80% over spot. That means people are paying $50 to $70 over the paper price just to get physical metal. These are all early warning signs of a market that's running out of physical supply. Now, here's what happens when a major bank or a major exchange invokes force majeure. Step 1, they announce that due to extraordinary market conditions and inability to source physical silver, they will cash settle contracts rather than deliver metal. Step 2, panic. Every participant in the silver market realizes that paper contracts are not actually backed by physical metal. The ratio of paper claims to physical silver is somewhere between 100 to 1 and 350 to 1, depending on whose estimates you believe. But whatever the exact number, it's clear that most paper contracts can't be honored with physical delivery. Step 3, rush to physical. Everyone who owns paper silver, SLV ETF shares, silver futures, silver certificates, tries to convert to physical at the same time. This is impossible. There's not enough physical silver to satisfy even a fraction of paper claims. Step 4, premium explosion. Physical silver starts trading at massive premiums to the paper price. We're not talking 30% premiums. We're talking double, triple the paper price. Dealers charge $200 per ounce for physical, while the screen shows $90. Step 5, market bifurcation. There are now two silver markets, a paper market where contracts trade at suppressed prices and settle in cash, and a physical market where actual metal trades at real supply and demand prices. Step 6, the paper market dies. Once everyone realizes paper contracts are just fiat currency with extra steps, nobody wants them. The paper price becomes irrelevant. The only price that matters is the physical price. And at that point, silver doesn't trade at $100. It trades at $150, $200, $300, or it doesn't trade at all because holders simply won't sell. This is not speculation. This is the actual playbook from every commodity market that's experienced a physical squeeze. Palladium did this, rhodium did this, cobalt did this, and now it's silver's turn. Now you might be thinking, Why don't the banks just cover their shorts? Why don't they buy silver, close the positions, take the loss, and move on? Great question. Let me explain why they can't. Reason 1, size. They're short 4.4 billion ounces. If they tried to buy even 1% of that position, let's say 44 million ounces, on the open market, the price would spike violently. Trying to cover would drive the price up so fast that their losses would accelerate faster than they could close positions. It's like trying to exit a burning building through a door that gets smaller the more people try to use it. Reason 2, liquidity. The COMEX trades maybe 100 to 200 million ounces of silver per day in futures volume. But most of that is speculative churning, not actual delivery. The amount of physical silver available for immediate delivery is tiny, maybe 1 to 5 million ounces per day maximum. At that rate, covering 4.4 billion ounces would take years. They don't have years. Reason 3, counterparty risk. These aren't simple short positions. These are complex derivative books with counterparties all over the world. Other banks, hedge funds, commodity trading firms. If Bank of America tries to cover by buying from Citigroup, and Citigroup is also short, you just have a circular problem, they're all trapped together. Reason 4, regulatory constraints. These banks are systemically important to financial institutions. They can't just blow up their balance sheets trying to cover silver shorts. Regulators would step in, shareholders would revolt, risk management would shut it down. Reason 5, the physical doesn't exist. Even if they had unlimited money and were willing to pay any price, there simply isn't 4.4 billion ounces of silver available for sale. It doesn't exist in concentrated form. It's spread across millions of industrial users, investors, dealers, mints, refiners. You can't just call up a mine and order 5 years of production delivered next week. So they're trapped. Absolutely, completely trapped. The only strategies available to them are Strategy 1, suppress the price as long as possible and hope something changes. Hope industrial demand falls. Hope a massive new silver discovery gets made. Hope the economy crashes and destroys commodity prices. Hope investors panic and sell their physical silver. This is what they're doing now. This is why they crashed silver to $86 last night. They're buying time. Strategy 2, lobby for regulatory intervention. Get the CFTC, the Federal Reserve, the Treasury Department to step in and impose price controls, suspend trading, force cash settlement, change the rules mid-game. Don't think this can't happen. When the system is threatened, rules change. They change margin requirements. They can change delivery requirements. They can suspend markets. They've done it before. Strategy 3, coordinate force majeure across all major institutions simultaneously. If everyone declares force majeure at the same time, no single bank looks uniquely weak. It becomes a systemic event that gets blamed on markets, not management. This is the nuclear option. This is the break glass in case of emergency scenario. And I believe we're getting close to that moment. All right, let's get practical. What does all of this mean for you? What should you actually do? If you own physical silver, do not sell. I don't care if silver drops to $80. I don't care if it drops to $75. These are manipulated moves designed to shake you out before the real move higher. The banks need your physical silver. They need you to panic and sell. That's the only way they can acquire the physical metal they desperately need. When silver crashed to $86 last night, physical premiums went UP. That tells you the real value of silver is rising even while the paper price is being suppressed. Hold your physical silver. In fact, if you have cash available and silver drops below $80, buy more. These dips are gifts. If you own paper, silver, SLV, futures, certificates, this is where you need to be very, very careful. Paper silver is at risk of force majeure, cash settlement, and total loss of value relative to physical. If you can convert paper silver to physical silver, do it now. Take delivery if you're holding futures. Redeem ETF shares for physical bars if you're an authorized participant. Buy physical coins and bars if you're in paper products. The spread between paper and physical is going to widen dramatically, potentially to the point where paper silver trades at $50 and physical silver is unavailable at any price. If you're thinking about buying silver, you need to understand that we're entering a different phase of this market. The old rules don't apply. Technical analysis is useless when you have institutional failure and force majeure risk. If you want exposure to silver, buy physical. Not paper, not ETFs, not mining stocks. Physical metal that you can hold in your hand or store in your own allocated vault. Yes, you'll pay premiums. Yes, it's less convenient than clicking a button to buy SLV. But when force majeure happens and paper contracts get cash settled at suppressed prices, you'll be very happy you own the actual metal. If you're thinking this is just another silver bug conspiracy theory, I get it. Silver bugs have been predicting the end of the paper market for decades. They've been wrong every time. Maybe they're wrong again. But look at the data. 4.4 billion ounces short. 800 million ounces per year production. COMEX inventories down 70%. US Mint suspending sales. China restricting exports. Physical premiums at 30 to 80%. This is not conspiracy. This is math. This is publicly available data. This is happening in real time. The paper market has survived this long because industrial demand was manageable and investment demand was sporadic. But now industrial demand is critical and growing, and investment demand is surging as people lose faith in fiat currencies. The system is breaking. The question is not if, but when. Let me zoom out and tell you what this really means. Because this isn't just about silver. This is about the entire commodity derivative complex. This is about the financial system's ability to price real assets. This is about the difference between paper promises and physical reality. For decades, the financial system has operated on the assumption that paper contracts are as good as physical delivery, that futures markets accurately price commodities, that you can have 100 paper claims on one physical ounce, and everything is fine because most people just want price exposure, not actual metal. This worked as long as everyone trusted the system, as long as physical supply was abundant, as long as nobody actually demanded delivery. But that era is ending, and silver is where it ends first. Why silver and not gold? Because gold is primarily a monetary metal held by central banks and investors. The gold market can tolerate high paper-to-physical ratios because most gold just sits in vaults. It doesn't get consumed. Silver is different. Silver gets consumed. Every year, hundreds of millions of ounces go into industrial products and never come back. Solar panels don't get recycled for silver. Electronics don't get melted down. The silver is gone. So the available above-ground supply keeps shrinking while demand keeps growing and paper claims keep multiplying. This is terminal, this is not sustainable, and when it breaks, it exposes the fraud in every paper commodity market. Oil, copper, platinum, palladium, agricultural commodities. All of these markets have similar dynamics where paper contracts vastly exceed physical supply. If silver breaks and forces force majeure declarations, every other commodity market becomes suspect. Participants start demanding physical delivery. Premiums explode. Markets bifurcate. The paper price and the physical price detach permanently. This is bigger than silver. This is the crack-a-boom in commodity markets. This is the death of financialization. This is the return to physical reality. And it's happening right now. You're watching it in real time. So here's where we are. Bank of America and Citigroup are collectively short 550% of annual silver supply. 4.4 billion ounces against 800 million ounces of yearly production. At $90 per ounce, that's a $390 billion liability, larger than the market cap of most banks. They crashed silver to $86 last night in a desperate attempt to avoid $100 and the margin calls that would follow. But physical silver is in backwardation. Lease rates are spiking, premiums are exploding, inventories are collapsing. The math is terminal. The short positions can't be covered. Force majeure is coming. When silver breaks above $95 and holds, we're not stopping at 100. We're gapping to 150 overnight when the first major institution declares they can't deliver. The paper silver market is dying. The physical silver market is being reborn at real supply and demand prices. And if you understand what's happening, if you hold physical silver, if you bought the dip last night instead of selling in panic, you're positioned for one of the greatest wealth transfers in commodity market history. The banks are trapped. You're not. Know what you hold. This is the end game. Welcome to the silver short squeeze that breaks the system.